Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I have to say, a lot of the brokers coming in at the moment are looking fairly haggard, and markets aren't easy out there. And I mentioned that in context of a weak market. And I know you want to start once again with the chart of the MSCI World Index, which some people might not have seen last week, and why you think it's pertinent to what's happening in the global arena at the moment.
Yes, that's right. It's understandable if a lot of the brokers that are coming in and giving market commentary are a little bit haggard, because markets have been weak for a while and they've got a very lackluster, sort of lethargic feel to them. And my feeling has been for a while that we're going into a bear market. And this MSCI World Index chart, I've brought it along again this week. We did cover it last week, you're right, but I just feel it's so important that I think it's worthy of getting another mention this week.
Okay.
And the graph of it is up on the screen at the moment. This is the MSCI World Index, and what it is it's an index that tracks about 1,600 global shares across 23 different developed markets in the world. And so, you know, it's a very, very good replication of, or good representation of global stock markets. It is fairly heavily skewed towards the US markets, but that's because the US markets do carry the heaviest weighting in terms of global equities. But nevertheless, look at this graph and notice what's happening here. This, by the way, is a weekly graph, and it goes back to 2013. So we're talking about 3 years' worth of trading history here. This big head and shoulders pattern that's evident over here has been forming over the last 2 years. And what's particularly relevant now is that we've actually seen these markets break below the neckline of that head and shoulders pattern. So that actually validates that head and shoulders pattern. And in strict technical analysis terms, you take the height of that head at its broadest point and you project that distance down to get your measured target. And in this case, it's pointing to a target of 57, which implies a 25% pullback from that recent high, which we saw in April of 2015. Now, we have broken below the neckline, as you can see very clearly there. We're rallying back up towards the underside of it now. My best guesstimate right now is that what we're going to do is probably bumble around here for a while, maybe even a couple of months, you never know. But probably challenge the neckline of this head and shoulders pattern, maybe even go slightly above it, you never know. Sometimes these bear market rallies can be quite vicious. But bigger picture, that head and shoulders pattern remains very much valid, and only if we start to break above the highest point of the right shoulder would that invalidate the head and shoulder structure. Until that happens, this head and shoulders pattern remains very much in force, and the downside target remains there. And it's not, you know, it's a question of how long is it going to take to get there, really, and not if. So it's not a good-looking setup, and I think we really need to stress this.
And I have to say that to get back above that right shoulder would take a lot from where we are at this point.
Yeah, it would take quite a lot, because it's got to rally a fair amount from this level. Not to say that it can't happen, though.
Sure.
But you know, the markets, when we had the crash in 2008, actually started very much looking very, very similar to this. We had a head and shoulders pattern, broke to the downside, it consolidated underneath the neckline of that head and shoulders for a while, and then we saw the sharp move down. Now, I'm not calling for a 2008 type crash again. I mean, that would be a little bit too bold to call for something like that, and I think the situation and the conditions are different now. But nevertheless, it does certainly point to further downside in these markets.
Okay, so taking it back home, before we talk about the trade that you've enacted for the portfolio this week, what are your thoughts on the top 40 at the moment?
Well, yeah, we've got the graph of the top 40 up at the moment. Now, this goes back over the last 2 years or so. What's particularly relevant, I suppose the most dominant feature of this chart right now, is this lateral support area at 41,000. You can see how many times that level has been tested, multiple times over the last 2 years. And we've tested it again recently. We are rallying again right now. Market has moved up quite nicely. It is moving into relatively overbought territory at this stage. So I think we've got to be careful and watch what happens over here. But my fear is that if we start to break underneath this 41,000 level on the top 40, that could spell quite a lot more weakness to the downside. And that kind of tees up this week's trade, because my feeling is that we probably are vulnerable to breaking below that level at some stage this year, and I want to be able to participate in that if that should happen.
And I suppose especially so because there's not much market breadth. I mean, the shares keeping the market higher are few and far between.
It's very true. There's the market breadth on the JSE is terrible at the moment, and it has been terrible for quite a while. Really and truly, there's two major shares holding our market up, and it's Naspers and it's SAB Miller. SAB Miller, obviously, because of the corporate action with AB InBev, is remaining elevated. Naspers, still relatively strong stock. But those two shares together make up over 30% of the top 40 index. Now, scratch underneath the surface of those, and the picture is really not looking good. You've got a lot of shares that are in bear markets, i.e. they're more than 20% off their highs. They're in firm downtrends and looking as if they've got lower targets in place. So the breadth is really not looking good for our market. And if you've got a share like, for example, Naspers just beginning to falter and maybe roll over a little bit, it could actually spell quite bad news for this top 40 index. And that could very well be a catalyst that takes us underneath 41,000.
Okay, so how to profit from all this doom and gloom then, Garth, and that is what you're going to talk us through today.
Indeed. We're doing another one of these option structures. Now, I know these things get quite complicated, so I'm going to go through it nice and carefully. What I like about these option structures is they give you downside participation without having to have a pure naked short position, which obviously a naked short loses you money if the market goes up. It works if the market goes down, but we want something that gives us downside participation without too much risk if the market rallies.
And I have to say, just on that point, I mean, you can find yourself easily wrong-footed by this market because, you took a long position, you stopped out, and then, you could have easily taken a short position. So you just, it's hard to find even footing.
It's volatile, and the ranges are fairly broad at the moment, the daily trading ranges. So it is a difficult and it's a choppy, tricky environment to navigate. So one does need to be very cognizant of that.
Okay, so talk us through what you've done.
All right, so what I've got here is a table that shows along the bottom axis here, these are the levels on the top 40 index. So currently we're trading close to 43,000 on the top 40. And you can see 44,000, 45,000, etc. On the left-hand axis here, we've got profit and loss. So anything above this middle line is profit. Anything below that line is loss. Now, I've done 3 legs to an option structure here, and I'll break them all down and then show you the summarized version of what it all looks like. The first is that I've gone long of one put option for June 2016. So this runs all the way out till the 3rd week of June. Long a 43,000 strike put option. So you can see at 43,000, this option starts to make some profit. And I've paid 16,401 Rand for this option, for this one put option. To give you an idea, one option here represents 10 Rand per point. So given that the strike is 43,000, that means I've taken effectively a short position of 430,000 Rand exposure on this top 40. However, I've paid 16,000 Rand for that. Okay. And the 16,000 Rand works out to about 4% of the value of the exposure. And that put option gives me the ability to profit from 43,000 all the way down to 0. But the market's not going to go to 0, so I can sell away some of that downside participation in order to recoup some of the premium that I've paid away.
Yes.
So in an effort to do that, I've then gone short of one put option, also June expiry, with a 38,000 strike. For this, I then receive 5,435 Rand. Because I've sold the option short, I actually get paid this premium. I receive that premium. In addition to that, I'm also of the view that the market's not likely to go screaming a hell of a lot higher. Yeah. So I'm also fairly content in that case to sell an out-the-money call option to then further reduce the premium that I have to pay for the structure. So I've gone and I've sold short one call option, also for June expiry, with a 47,000 strike. And there I receive premium of 12,106 Rand.
And that would imply that if the market were 47,000 or above, you would start to make money.
I would start to lose money on the call.
Start to lose money.
The overall payoff that I'll show you in a minute will illustrate that. But just have a look at what's going on here. We've got 2 options, the blue one and this orange one, the out-the-money call and the out-the-money put that I've sold short. I've collectively received 5,500 Rand and 12,000 Rand in premium for those 2. And I've paid away 16,500, call it, for the one long put option. So what I'm paying away on the one hand, I'm receiving pretty much an equivalent amount almost on the other hand. So what's nice about this is it's pretty much a self-funding structure.
Yes.
I don't have to pay away any money. In fact, I actually earn a little bit of a profit by doing this. Now that yellow line tidies it all up. So let's just take away all the other lines and neaten it up a bit so that you can see exactly how the payoff profile is going to look once you take away all the complexities of the 3 different options legs. So there you go. You can see that above 43,000 and up to 47,000, I actually keep a premium of 1,140 Rand. I earn that premium. Only above 47,000 would I then start to lose money, but I can hedge that risk if we get there. Below 43,000, I make money and I make money and I make money all the way down to 38,000 on the top 40. Below 38,000, my profits are then capped. I can't make any additional profit below that level. But my maximum profit is 51,000 Rand, which is huge. So effectively, the only thing I've got to worry about with the structure is if the market rallies beyond 47,000, then I might have a problem. But other than that, I'm very, very content to have this structure in place because it gives us downside participation. And it's out until the end of June, so it gives us lots of time.
And if the market trades between 43,000 and 47,000, that just means you have a neutral position in the market.
Well, that's
You're not going to make anything
I'll effectively keep that 1,140 Rand premium. So I've actually been paid a little bit of money to do this, believe it or not.
I mean, Garth, how did you manage that to get, because sometimes it can be expensive if you're taking, essentially short positions in a market that is already weak, because it actually becomes more expensive to take those short positions. Whereas if the market was running wildly, everyone would say you're crazy to go short. So it wouldn't actually cost you as much, if I understand things correctly.
You're 100% right. What it talks to is the volatility, because one of the big pricing elements of options is the volatility level. Because markets are quite volatile at the moment, volatility levels are high. But remember, because I'm selling short the wings of the structure, I actually receive quite a good volatility payment in my favor. And that's why I've actually managed to get it very cheap. In fact, better than cheap, but we're even earning a little bit of money here. The other thing also why we've managed to receive a bit of premium is because this is quite a long-dated option. It runs out almost about 5 months, actually, to the 3rd week of June. So there's a lot of what we call theta. It's a Greek word for time value. And there's a lot of theta embedded in these options, which we also receive when we sell short the wings of the structure.
Garth, have you got any graphs against which, for example, on how the market would trade, how did it actually pay off?
Yes, I do. So here's a graph of the top 40 again. Just to reiterate, that level of 41,000 is the critical level in the line in the sand that we're going to need to monitor this year. If we break down below there, then it looks problematic for our market. Now, the options payoff looks like this. So I've taken that payoff profile that I had on the previous slide, and I've just turned it on its side. And I'm showing you that here, below 43,000, we start to make money. Down to 38,000 here, we make our maximum profit. Anything up to 47,000, we're fine. Above 47,000, we would start to lose a bit of money, but I can hedge that out.
Yes.
So that I can sort that out if we need to. So really and truly, I really like this structure because it gives us this downside participation if we are so worried about markets this year.
And Garth, you've put on quite a few of these portfolio, and I think you've probably refined your technique. And you could be accused of maybe taking unnecessary pains with these because they hadn't worked out, but you have had some gains from your option structures in, I'd say, the last year.
Yes, we've done them. I think we've done them over the last 2 years, actually, because I've been concerned that the market may break down, and it may break down. It hasn't really. And we've made money on 1 or 2 of those structures, but a lot of them have just expired worthless. But what I like to think is that those were all sort of rehearsals for when the big move to the downside does eventually come. And I said all along that if we get into a bear market, this is the type of structure I would like to employ in order to take advantage of a downside or a bearish market.
Yeah. Okay, so that's what you've done for the portfolio, and people can watch the video again and also go onto your website, I'm sure.
Yeah, yes.
Garth, so what does the portfolio look like at the moment?
All right, so we're still a little bit underwater. We're down 1.65% for the year to date, mainly because of that long top 40 future, which burned us about 2 weeks back. But we're short of cash build still, and we're making some money there. And then this option structure that we've done today, I'm accounting for that 1,140 Rand of premium that we've received with today's figure.
And then, Garth, you had a course this past weekend. You've still got another one. How did it go?
It went well. I've adapted my high probability trading course to be more focused towards looking for bear market setups and how to trade successfully in a bear market. So the one that I did in Johannesburg this past Saturday went very, very well. I've got another one coming up in Cape Town on the 5th of March. And then also my colleague Andrew Todd is running a top 40 trading course this week, Saturday, in Johannesburg. That's the 6th of February. So anybody that would like to attend either of these courses, please email me on garth@traderscorner.co.za, and I'll send you all the information.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner. you.